Welcome back to Financial Market Insights for Traders, your go-to podcast for everything market related, from commodities to currencies, futures to financial freedom. I'm your host, Sophia, and today we're diving into one of the most influential forces in the global economy, crude oil. If you've ever wondered what really moves oil prices, or how you can actually trade this commodity without owning a single barrel, you're in the right place. Whether you're just beginning to explore how to invest in commodities for beginners, or you're brushing up on futures options basics, I'm breaking it all down for you. Clear, thorough, and straight to the point. So, grab your notepad or just tune in while you commute, because today's episode is packed. Segment 1: What really drives the price of crude oil? Oil prices aren't pulled from thin air. They're a reflection of global events, market behavior, and economic fundamentals. Let's kick off with the big drivers. Number 1, supply and demand. This is ground zero for understanding oil. When the global economy is booming, airlines, shipping, manufacturing all demand more fuel. Demand rises, prices rise. Conversely, when supply floods the market, maybe due to new oil fields going online or OPEC countries increasing output, prices drop. A great example? Post-COVID recovery. Demand for oil came roaring back, but production was slow to catch up. That imbalance sent prices soaring. Number 2, OPEC, and now OPEC Plus. The Organization of the Petroleum Exporting Countries is essentially the cartel of crude. Their decisions on how much oil to produce can move prices dramatically. When OPEC cuts production, it signals scarcity. Prices go up. When they boost supply, prices often fall. These days, OPEC Plus includes Russia and other non-member allies, and they have massive sway over global oil trends. Their monthly meetings are a calendar must-watch for anyone in oil trading. Number 3, geopolitical risk. Oil isn't just about economics, it's deeply political. Tensions in the Middle East, sanctions on countries like Iran or Venezuela, or conflicts like the Russia-Ukraine war. All of these can choke supply and push prices higher. For example, any threat to the Strait of Hormuz, a key waterway for oil shipments, can send shockwaves through the markets. Number 4, currency strength, especially the US dollar. Oil is priced in dollars. A stronger dollar makes oil more expensive for foreign buyers, typically pushing prices down. A weaker dollar does the opposite. That's why traders closely watch Fed interest rate decisions. They affect currency values, which then ripple into oil. And finally, number 5, speculation and inventory data. This is the Wall Street layer. Traders buying and selling futures contracts based on forecasts or gut instinct. Weekly inventory data from the US. Energy Information Administration can cause sudden spikes or drops in oil prices, based purely on whether there's more or less oil in storage than expected. Segment 2, how can you trade crude oil? Now that you know what drives oil, let's talk about how to get in the game. No, you don't need an oil rig in your backyard. There are multiple, modern ways to trade oil. First up, oil futures contracts. These are legally binding agreements to buy or sell oil at a specific price on a future date. They're traded on exchanges like NYMEX. The most well-known benchmarks are WTI, West Texas Intermediate, and Brent crude. Trading futures is powerful, but it requires a margin account and a real understanding of how contracts roll over, how leverage works, and how to manage risk. It's not beginner-friendly by default, but if you're aiming to master futures options basics, this is your playing field. If you're looking to test the waters in a beginner-friendly environment, check out crystalballmarkets.com. They offer margin trading with intuitive interfaces designed for newcomers to energy commodities. That's a great place to learn with less friction. Option 2, oil stocks. Buying shares in companies like Chevron, ExxonMobil, or even service companies like Schlumberger gives you exposure to oil. These stocks tend to rise and fall with crude prices, but they're also influenced by company-specific factors, earnings, management, and innovation. Some of these companies are even investing in green energy, giving you a hybrid exposure to both fossil fuels and renewables. Option 3, oil ETFs and mutual funds. Want simplicity and diversification? Exchange traded funds like USO or XLE give you exposure to oil prices or oil producing firms. Some mirror spot prices, others hold futures or equity baskets. If you're researching commodity investing explained simple, ETFs are your answer. They trade like stocks, are easy to access, and are often tax efficient. Option 4: Options on oil futures or ETFs. Here's where strategy meets complexity. You can trade calls and puts on oil contracts or ETFs. Options let you hedge, speculate, or create complex strategies with controlled risk. Just be sure you really understand the underlying asset. Options are powerful but unforgiving if you're unprepared. Segment 3: Pros and cons of oil trading. Let's zoom out for a second. Should you even trade oil? The pros: \n, it's incredibly liquid. That means tight spreads, fast execution. \n, it reflects global macro trends. So if you follow economics or politics, oil makes sense. \n, you've got multiple access points: futures, stocks, ETFs, options. \n, it can diversify your broader portfolio. The cons: \n, oil is volatile. You can gain big and lose big fast. \n, it's impacted by unpredictable geopolitical events. \n, understanding the moving parts takes time. \n, you've got to monitor it closely. It's not set and forget. Segment 4: Oil versus other alternative investments. Maybe you're weighing oil against other assets. Let's compare. Oil versus gold. Gold is your safe haven. It holds value in crises. Oil? It booms in economic upswings and busts when things slow. If you're choosing between gold versus stocks investing, oil offers greater upside and risk. Gold is steadier. Oil versus REITs. REITs give you dividends and exposure to real estate. Oil offers no yield, but far more price movement. If you want income, REITs win. If you want action, oil wins. Oil versus stocks. Traditional stocks, think tech or healthcare, might be less volatile than oil, but they also don't move in sync with macro trends the way crude does. Oil is one of the most responsive commodities out there, which is great if you understand timing. If you're curating a portfolio of alternative investments for 2025, a mix of oil, gold, and REITs might be your best bet. Segment 5: Learn from the pros. Still figuring it all out? Don't go it alone. Listen and learn from those who do this daily. I highly recommend tuning into the Crystal Ball Markets podcast. It's a solid commodity trading podcast packed with beginner-friendly insights. They cover crude oil, central bank news, commodity forecasts, and trading psychology. It's sharp, it's timely, and it's made to fit into your busy life. Whether you're an auditory learner or just like staying updated on the go, it's a gem. Final thoughts. Oil isn't just about gasoline prices or barrels in the ground. It's a window into global economics, politics, and trading opportunity. If you're just learning how to invest in commodities for beginners, or if you've been comparing buying gold or stocks, which is better, oil offers a high stakes, high reward opportunity that's hard to ignore. Just remember, no shortcuts. Educate yourself. Start small. Use smart platforms. And don't trade based on headlines alone. When you're ready, head over to crystalballmarkets.com to start your journey into oil and energy trading. It's built for learners, backed by real tools, and ready when you are. Stay sharp, trade smart, and as always, keep learning.